Hello, I'm Edward Sterling, macro analyst for Bulwark Bullion. Gold just experienced something that almost never happens. Over the past several weeks, the metal has suffered its worst losing streak in roughly a century. That sounds dramatic, and it is. But what's even more interesting is that the broader macro environment hasn't changed as much as you might expect. Inflation risks remain. Global debt levels are still rising. Geopolitical tensions haven't disappeared, yet gold sold off aggressively. So the real question investors should be asking right now is simple. Why did gold fall so sharply? And does it actually signal something bigger for the precious metals market? Let's break down what happened. Gold has been in a powerful bull market for much of the past year. Strong central bank demand, geopolitical uncertainty, and rising concerns about long-term currency stability helped push the metal to record levels. But markets rarely move in straight lines. Over a short period recently, gold recorded a series of consecutive weekly declines, creating what appears to be one of the longest losing streaks the metal has experienced in about 100 years. That kind of move naturally caught investors' attention. When you see an asset that has been rallying suddenly reverse and keep falling week after week, it raises concerns that the trend might be breaking. But when you zoom out and look at the broader macro backdrop, something interesting appears. The sell-off may have been less about fundamentals and more about positioning and macro repricing. The most important driver behind the recent gold sell-off appears to be rising real interest rates. Gold tends to move inversely with real yields. Why? Because gold doesn't produce income. So when real yields rise, meaning investors can earn higher inflation-adjusted returns from government bonds, holding gold becomes relatively less attractive. Recently, bond markets have been adjusting expectations around interest rates and inflation. Investors began pricing in the possibility that central banks may keep policy tighter for longer than previously expected. That pushed Treasury yields higher. And as yields climbed, real yields moved higher as well, which created direct pressure on gold prices. This relationship between gold and real yields is one of the most consistent macro mechanisms in financial markets. And in this case, it likely played the largest role in the recent losing streak. But rising real yields weren't the only factor. There were several secondary forces amplifying the move. First, the US dollar strengthened during the same period. A stronger dollar tends to pressure commodities priced in dollars, including gold. When the dollar rises, it effectively makes gold more expensive for buyers using other currencies. Second, we saw profit-taking after a massive rally. Gold had already surged dramatically over the past year. When an asset moves that far that fast, it often attracts speculative momentum traders. When prices begin to stall, those traders frequently exit quickly, accelerating short-term corrections. And finally, market psychology played a role. Once investors noticed the losing streak building, sentiment shifted. Short-term traders began betting on continued downside, which can reinforce the move. So how did these forces combine? The chain reaction looked something like this. Bond yields rise. Higher yields push real interest rates higher. Higher real yields increase the opportunity cost of holding gold. At the same time, the US dollar strengthens, creating additional pressure. Short-term traders then begin locking in profits after the long rally. And the result is a rare event, a prolonged losing streak in the gold market. Before we go further, if you're enjoying this breakdown of the precious metals market, make sure to hit the like button and subscribe to the channel. Despite the recent pullback, the broader macro picture for gold hasn't necessarily changed. Central banks around the world continue accumulating gold as part of their reserve diversification strategies. Global debt levels remain historically high, and inflation, while somewhat lower than its peak, is still a major concern for policymakers and investors. These longer-term structural factors are part of the reason gold has performed so strongly over the past several years. Short-term corrections can happen within larger bull markets. In fact, they often do. I've watched commodity markets long enough to know that some of the sharpest pullbacks tend to occur during strong bull cycles. So what indicators matter most going forward? First, real yields. If real yields continue rising, gold could remain under pressure. But if yields stabilize or begin moving lower again, that could quickly shift the outlook. Second, the US dollar index. A weaker dollar tends to support gold prices, while a stronger dollar can create headwinds. Third, central bank demand. If global central banks continue accumulating gold at the pace we've seen in recent years, that could provide a powerful underlying floor for the market. And finally, watch broader risk sentiment in global markets. Periods of financial stress or geopolitical instability often drive investors back toward safe haven assets like gold. The key takeaway here is that even historic losing streaks don't necessarily signal the end of a trend. Sometimes they reflect a short-term macro repricing, particularly when interest rate expectations shift quickly. Gold's worst losing streak in a century sounds dramatic, but in many cases, these kinds of corrections are exactly what occur inside larger, long-term bull markets. If real yields begin falling again while global central banks continue accumulating gold, could this historic losing streak end up being just a temporary pause before the next major move higher? Thanks for watching. If you're interested in gold, silver, and the macro forces driving global markets, make sure to like the video and subscribe. For more analysis, visit bulwarkbullion.com. I'm Edward Sterling, macro analyst for Bulwark Bullion. See you in the next one.